Welcome to Talk Tickers. Today, we are digging into Grindr's Q3 2025 earnings. And look, on the surface, this was a fantastic quarter with some blowout numbers. But underneath all that, there's this controversial buyout offer that's creating a massive disconnect for investors. So let's break it all down.
All right, here's the game plan. We're going to start with those impressive headline numbers. Then we'll dive inside the quarter to see what is really powering all this growth. After that, we'll look ahead to the future with AI and pricing before we tackle the elephant in the room, that $18 buyout question. And finally, we'll put it all together and give you our take on what to watch for next.
So, November 6th, right after the closing bell, Grindr dropped its numbers. Now, investors were watching really closely for a clear sign of strength, and they absolutely got one.
First up, the top line. Revenue came in hot at $116 million. Now that's a solid 2% beat versus what the street was expecting, and it represents a really healthy 30% growth year over year.
But the real story here was on the bottom line. Diluted EPS came in at 16 cents, absolutely crushing the 12-cent estimate. A 33% beat like that just shows you how efficiently this company is running. As that revenue grows, a bigger and bigger piece of it is dropping straight down into pure profit.
And the market's reaction? It was immediate and decisive. The stock just surged 11% the next day on nearly double its average trading volume. That's a huge vote of confidence from investors, right there.
Okay, so what was the engine behind those awesome headline numbers? Let's pop the hood and take a look.
The CEO, George Arison, he set a really bullish tone on the call. He framed the quarter as awesome, his word, and he immediately pointed to that powerful combination of rapid top-line growth and record-setting profitability.
And this is where the surprise upside came from. Yeah, direct subscription revenue grew a very healthy 25%, but it was the advertising business that just exploded, surging 56%. This growth, which was driven by international partners, shows that this powerful second revenue stream is absolutely firing on all cylinders.
The user base gives them a really solid foundation for all this growth. The platform's got 15.1 million monthly active users, but the key metric to watch here is payer penetration, which ticked up to 8.6%. What that means is they aren't just attracting users, they're getting better and better at convincing them to actually pay for premium features.
So here's the crucial point. This growth wasn't just for show, it translated directly to the bottom line. The company hit a record adjusted EBITDA margin of 47.4%. And get this, they converted about 94% of that into free cash flow. That is an incredibly efficient business model in action.
All right, so with a great quarter in the books, where does management go from here? Well, the focus is pretty clear. Push profitability, invest in new tech like AI, and really test how much pricing power they actually have.
Management signaled some serious confidence for the rest of the year. They actually raised their profitability guidance, that's the adjusted EBITDA, while keeping their strong revenue forecast. This implies they expect margins to stay super high. They did, however, throw in a little warning that Q4 will have a hard time matching Q3's spectacular ad revenue growth, what we analysts call a tough comp.
On the call, management really hammered home two key strategies. First, they've got real pricing power. Recent price hikes had a tiny, almost negligible impact on users signing up. Second, they're going all in on AI to create what they call a magical experience, which they plan to monetize through a new premium tier that's already in testing.
But all this fantastic performance is happening in the shadow of something way more complicated. There's this controversial proposal to take the company private, and it's casting a huge cloud over the stock.
So in late October, right before the earnings report, the majority shareholders, who by the way already control over 60% of the company, they submitted an $18 per share offer to buy the rest of Grindr. A special committee of independent board members is now looking at that proposal.
This timeline really lays out the puzzle perfectly, doesn't it? An $18 per share offer is announced. Then the company reports a complete blowout quarter. So why on earth did the stock close the next day at just over 15 bucks, almost $3 below the offer price?
That gap, which has been hovering around $3 to $4, basically quantifies the market's deep uncertainty. It means investors are being forced to weigh the company's strong fundamentals against the very significant risk that this deal doesn't close at $18, or maybe doesn't close at all.
So how do we balance these two powerful forces? Amazing execution on one side, massive deal uncertainty on the other? It's time for our take on what investors should be watching.
The central question for investors right now is this: How do you position for a stock that's being pulled in two completely different directions? You've got stellar operational results that suggest upside, and you've got this complex deal situation that creates both a potential price ceiling and some serious headline risk.
So here it is, our call for Q4. We expect the business itself to keep performing well. Look for revenue around $118 million, EPS near 13 cents. But frankly, the fundamentals aren't going to matter nearly as much as headlines about the buyout. We think the stock is going to be stuck in a range, kind of pinned between its strong underlying value and the uncertainty of that $18 deal.
And for that reason, our rating on Grindr is market perform. The company is firing on all cylinders, and look, without the buyout offer, we'd probably be a lot more bullish. But as it stands, that proposal puts a ceiling on the stock and introduces way too much risk to justify a higher rating right now. This is not financial advice.